The whispers on the trading floor are all about one question. Is volatility back with a vengeance? Last week, we took a 4% joyride in small caps going up and down. And this earnings season, tech stocks defy gravity with an 80% win rate. Sounds thrilling, right? But hold on to your horses because beneath the surface, dark clouds are brewing. Since December, financials, it's been like riding a rickety roller coaster uphill. But instead of screaming in fear, investors are actually oddly calm. Is this the calm before the storm? Well, buckle up because when the market goes higher and volatility goes higher, it is the perfect storm. Now, don't panic. For some investors, this roller coaster ride could be a dream come true. But it could be like staring the loop down the blindfold. And to add fuel to the fire, one of the biggest earnings events in my lifetime for options traders is just around the corner. NVIDIA, the chip giant, was worth a mind-blowing $1.6 trillion, and it's about to unveil its report card. The market is betting on a wild 10% swing. Imagine the market cap changing by a whopping $160 billion. That's got to be a record, right? And all this drama is unfolding just before March. Just before March Madness. It is going to be mayhem. So I just have to ask you, Brian, is volatility back?
Well, you look at those charts, and it's actually very concerning. Is winter coming, as you saw there for Game of Thrones, or not? It might be. I mean, it's kind of an interesting market the last few weeks here. As you mentioned, volatility up, stocks up. That typically is a sign of a market top. Now, can stocks go higher off of that? Yeah, they can. We've seen that before, where we've seen volatility rise off very low levels. Implied volatilities of options trading very low relative to historical beings, and the market continues to rise. So even though hedgers go out there and buy a hedge against their portfolio, the market can continue to rise. But we do have a few things coming up this week. The FOMC minutes, that will be sort of interesting as a read and a take on it. I think we're going to get into our show here where the Fed futures fund rates are going, where the market expects it to go, how that's affected valuations. So it's definitely an interesting week as we get to the back half of this. And obviously it's a short week, so people really repositioning to start in the market, obviously struggling today.
Yeah, speaking of repositioning, last week we brought this up, this in sentiment. This was very, very low levels of last week. We're at 22.6, and just in 1 week we've risen all the way up here. So certainly maybe it's a sign last week was the start of something. We'll wait and see. That CPI number certainly was big, but there is a much more of a bearish tilt this week.
Yeah, I mean, when you look at this CNN Fear and Greed Index, it's tipping on the side where the market has seen its run to the upside historically. And so when you look at this, it has a bunch of indicators in here. All these indicators are flashing greed, except for one. The volatility indices are not, but that's kind of peculiar only because we've seen a pretty good vol pop today. We saw a pretty good vol pop last week, meaning the VIX kind of spiked up. The spikes index also jumping higher here. Maybe that's a little bit overdone, and that's why it's sort of dampening this needle out of extreme greed. But if volatility sort of backs off and there's sort of this comfort in the market, then, we may see this extreme greed creep back in and being sort of an overbought condition in the stock market.
Yeah, and to me, it's actually a subtly more extreme greed than this reading is actually even factoring in, because the volatility component is not showing any greed. In fact, the volatility component is showing extreme fear. That's kind of pushing the whole index off of the extreme greed. But I think it's misleading because volatility is coming from such a low level that it's not really giving a fair showing. All right, so let's go back to interest rates. We've been watching this very closely. This is the market's expectations for the end of the year's interest rates, and it's shifted in a big way.
It has, and we're starting to see now people on the Fed funds futures or expectations of where the Fed will cut, how much they will cut. It's actually starting to creep more, shifting to the point where we're not going to get as many rate cuts as we once thought that people were expecting at the end of the year. So that shift maybe starts to play into some things to shift valuations in the stock market.
Yeah, this is where we were just a month ago. So last week's Fed meeting, they certainly have shifted things. And this is something we've been watching, following since last year. And actually, this is a chart that shows the Fed funds futures, how the expectations have shifted. And just kind of look at this. This green line is where we were at the end of October here. End of October, we were green here, and interest rates were much higher then. We had a huge sell-off to end the year. This is where we ended the year down all the way here, the end of December here. And of course, the market's had a fantastic run now since then. Now, the market's actually still closer to its highs. And maybe this is one of the reasons why the market's up and volatility is up, because the interest rates have come all the way back up here. We're getting closer to where we were in October. Now, we're not all the way there yet, but this certainly is a sign that the market, if it were at the same place when rates were here, it could be lower.
Yeah, I think if you look at where the Fed funds rates were sitting, sort of like you mentioned right here at the end of the year, how that all shifted down, that allowed the stock market to move significantly higher as people repriced valuations on stocks. Now we're getting a return back to the normal. That green level is where we once were in the fall of last year. And remember, the market was about 10% lower back then, and even a little bit more. So could we be in for a little 10% correction off the highs? Certainly there has to be some sort of give and take, median repricing of things, given where interest rates are currently sitting, as they sit more towards that high end of that green area where we were in fall of last year.
Yeah, well, that's one of the big reasons we talk about the market higher, volatility higher, the perfect storm. Let's bring it into the big story here. So when we talk about volatility, remember, typically people think of volatility as this negatively correlated component, negatively correlated index. When the market goes higher, volatility goes lower. That's something that is typical of the index. Now, the other thing that, something we talked about last week is that typical of volatility is that it mean reverts. It wants to move to the average. So when market goes, when the volatility tends to be cheaper, as it's easier to go higher. When volatility is higher, it's easier to go lower.
Yeah, and when we talk about volatility, we're talking about the cost of insuring a portfolio, essentially, meaning the premium relative to other times in the market. So we're not really considering a certain point in time or a price in the stock market. We're looking at a comparison of apples to apples. What's the cost of insurance? And typically what happens is as the market rises, historically, volatility or the cost of insurance declines. People actually get a little complacent. They don't want to spend as much to pay for insurance because the market's going higher. They rather not own the insurance. Well, what happens on turning point or inflection points is what we see is actually insurers say, wait a second, maybe the market's run a little too far. Maybe I actually should own insurance on this market, on the stock market. And they start pushing the price of premium of options up. And so that's where we're talking about volatility now going up. With the market going up, it actually fits really well in our style of trading, Joe, our model. We actually rolled our put position last week. We actually brought it closer to at the money because we're a little bit fearful of this volatility rising into this sort of seasonal trade time period.
Yeah, and just as you mentioned, we're kind of at one of those inflection points since December of last year. We're seeing the market higher, volatility higher. It's kind of phenomenal. You look at the SPY index up 9+% since December. The spike index up 12+% since September. So we're getting this one of those inflection points. We're seeing this market higher, volatility higher. I can actually think back in history. There have been times in February specifically when we saw this event. Actually, pre-COVID happens to be one of those events, Brian. If you remember, it was out there that COVID was an issue in 2020 in February. People were kind of concerned about it. And for some reason, defying all expectations for the first 3 weeks of February, the market kept going higher. And then, of course, it tipped over right after February options expiration. So we had the last week of a disastrous week of February. So that's one time, Brian. I also remember 2007 as another year I want to bring up. Of a time when we had the market higher and volatility higher. Now, I don't think we're going to see a COVID event this year, but maybe this looks a little bit like 2007.
Yeah, that Joe that's a little scary, that chart, right? I mean, take a look at that. Let's just break it down a little bit. You see the spike in 2007. We started having some problems out of China. We're seeing that now with the commercial real estate, whether that's spilt over. We got a volatility spike in February 2007 as volatility was sort of ticking up. The market backed off. But like we said, volatility can go higher. The market can continue to go higher as it did for the rest of 2007. It took a full year for things to sort of circulate through the system. So it is scary. I want to own a hedge like we're doing right now, Joe, for our clients, because we are, it seems like we could get this volatility spike. So I want to own some insurance on a portfolio, buy some puts, but that doesn't mean the market's going to just all of a sudden roll over like that chart you saw in the beginning. Can you scroll back to the beginning of the very first chart? Can we go back even one more time period where we got this bubbly, I don't know, as a Mag 7, the bubbly radio era of the 1920s, all the way at the beginning with the Great Depression. What was that correlation on that first chart? If we could go all the way back to the beginning here.
Yeah.
Back then, look at that. We have a 94% correlation rate between the market now and the 1920s. That's a little scary for me, that this actually market up is just a full rollover that happens rather than some back and forth action where we get some volatility spikes, some sell-offs, and then we back and fill and recover. So I would be watching that. That makes me nervous.
Yeah, I mean, you probably can pull up a lot of charts and statistics and come up with similar things, but a 94 correlation, that's something we can't really ignore. I just have to say that. Yeah, so okay, back 2007, like we were talking about, we're right into this seasonal part of the year. So this is, today's perfect example. This is just kind of what happens after Feb expiration. For whatever reason, this happens time and time again, and we get this March Madness type of trade. And Brian, what are you thinking potentially for the future?
Well, it does feel like there needs to be some sort of correction, repricing. We talked about the Fed's rate, interest rates a little higher than what people expected things to be, and now it's kind of normalizing out. And could we get a sort of back and fill kind of thing? Let's look at the lows of October. I don't know if we get all the way back down right away, but here's a typical like head and shoulders pattern that could start to form. This is just something to keep an eye on, where all of a sudden we get a sell-off. It goes a little bit further than people expect. We get below 4,500 on the S&P, we probably back and fill back up to that level. So I don't think it's just, get out of the market then, but that'll freak some people out. That'll shake people out of the market where now all those buyers before want out and they're looking to sell. And then 4,500 all of a sudden, which was once kind of a breakthrough out to the upside support, becomes resistance, and then it rolls over in this head and shoulders topping pattern. So that's just a pattern to look forward in the future if we get a further shakeout than what people expect.
Yeah, I know you're not saying this is going to happen, but this is just something to potentially watch out for sure. Yeah. Seasonality is lining up. The concerns are there now. Yes, there are some signs out there, but back in 2007, people were worried about real estate. People were worried about banks, but there was no mortgage-backed security credit crisis at that time. It took a year for that to actually materialize. I know there's corporate real estate issues. I know there's geopolitical concerns. There could be some sort of flash crisis that could happen anytime. But I don't think pricing that in makes sense. It does make sense having protection on more so now than in previous times.
For sure.
Because of course we are headed in. We showed this week after week, headed into this volatile March Madness, we should say. All right, let's go into the trade ideas for the week. I only put one earnings on there, NVIDIA, because that's the only thing that matters for earnings this week. Brian, we're looking at a 10.5% implied move, which obviously is very high, but for a $1.6 trillion stock, have you ever seen anything like this?
Yeah, this would imply that, what is that, $168 billion move in the market cap of a company off an earnings report? I don't know if I've seen a company move their market cap that much. Meta obviously was up huge. Maybe that is like a psychology in people's mind on what kind of movement NVIDIA can have. And really, NVIDIA is not going to be about fundamentals. It's going to be about their guidance and where they see the chip orders coming through based on AI and how much demand there is for that. But you look at the stock today, AMD, NVIDIA down pretty sharp today, which is probably leading the market lower. It's why you're seeing the NASDAQ off quite a bit on the day. And I wonder if the news is out. Somebody's got the news somewhere or something that they're expecting Nvidia to come in a little bit lighter than expectations. Does it
We're
make a
also
10%
seeing
move? I don't know.
the meme stock. It's not a meme stop, but it reminds me of meme stops. The SMCI, the super micro, it's down another 10% today. So this is well off of its highs. Maybe that was a sign of these chips, these AI bubble kind of frothing up a little bit, because that stock was just at astronomical levels, over $1,000, up just crazy amounts in just a few months. So maybe that was a sign people got a little ahead of themselves in this space. We'll have to wait and see. This obviously is a critical earnings event.
Yeah, I mean, Nvidia was in this sort of trend channel like you see here, where it was moving higher, it was in a nice channel. It kind of got a little exuberant, mean, stocky, kind of way. And so it got out of that channel. It broke out to the upside. And what tends to happen is you get this mean reversion back into the channel. And so I kind of want to play that there might be this possibility where it moves back into the upper end of this channel. But I also feel like a 10% or more move that the options are implying seems enormous. And I kind of want to take advantage of it. I'm not really typically a big person of selling wings into an earnings event, because all of a sudden you get, some sort of surprise and the market blows through those wings and it gets kind of scary. And then you got to figure out what to do. But here's maybe a very safe way to do it. Maybe take 1% of your portfolio. This is probably what I'd be looking to do. And like sort of my trading aspect portfolio. I'm going to do a time spread. So just listen tightly here because it's a little confusing. With Nvidia around 684, I'm looking to buy the March 610 put. I'd pay $17 for that. At the same time, sell the weekly. This is an option expiring this Friday, selling the 610 put as well, but one that expires this week for $9.40. Net debit of $7.60. So here's what happens. If the stock drops below 610 before Friday and stays below there come Friday, I would be put to the stock, but I'd also have my other put protection against that, right? So if it then continues to stay below 610, the most I can lose on this trade is the $7.60. That's what's kind of nice. Like I'm selling some option wing, yet I'm sort of limiting my risk to the stock. If the stock moves higher, what happens? That short-term put just expires out worthless. I'm left with a 610 put expiring out in March, and I'm hoping the value of that put is greater than the $7.60 I'm going to outlay. So how does that happen? Well, typically it's when the stock moves higher, but not significantly higher. So maybe we get some back and fill from today. Maybe people are a little scared today. Maybe earnings beat a little bit than what expectations are, and the market rallies a little bit. But this is basically kind of playing the way I anticipated, about an $80 range in the stock post earnings. I expect this to be a winning trade. So that's kind of what I'm playing for. And I'm not risking a lot because I'm only risking that $7.60. So I can get some defined premium pay, figure out how to size this up. Like I said, if I'm going to spend maybe 1% of my portfolio, a 0.5%, that I'm just willing to lose in case the stock just drops out of bed or just rips significantly higher, that's my risk.
Yeah, I think that makes a lot of sense to me, Brian. So remember, the average historical move is just 7%. We get an implied move of 10.5%. Your strike price is a little bit below that implied move. So if it moves a historical move down, I think you're going to be pretty happy with your trade. Is that about right?
Yeah, that would be the perfect scenario, right? The stock continues to sell off a little bit to the downside, but doesn't blow through that 610 strike level, which is right where the options are implying it'll get to. And then that put option expires to come this Friday. I'm left with the 610 put in March, which should have significantly greater value than the $7.60 I outlaid. So then I can go ahead and sell that March put. So this is one you're going to want to watch, and we'll keep you up to date on it as we sort of update our trades. Follow us on Twitter at Brian Stutland, at Joe Tige, and keep up with us on social media on this trade.
Yeah, so you want it to stay above here by March, and then to trend down here after that.
Yes, that would be ideal for sure. But I might take it off before then. We'll see how it plays out and how the earnings look out.
All right. Well, that makes a lot of sense to me. One thing I know is that given the implied move here, being long at these levels is pretty risky. Obviously, being short at these levels has the same risk out there. So options having an options position on in this earnings event really makes a lot of sense to me. Let's move it on to the question of the day. I'm not seeing any questions out there in the comments. Feel free. Every Monday, typically we are live at 1 Eastern. This is a Tuesday show because we had a holiday on Monday. Feel free to join us live. Really appreciate everybody who does join in. It means a lot to Brian and I. We're former options market makers. Brian was one of the early adapters in the VIX pit. We're using what we've learned as market makers to help you guys and help our clients out with our strategy. So it really just means a lot to us for joining in. And if you're watching us on YouTube, don't forget to, if you like this content, if it's useful to you, if you're this far into the video, you definitely do. So subscribe, like, comment, share it with your friends and relatives and everybody else.
All right, so we like to wrap up the show here for the new option traders out there. We call it our Options 101 strategy. I'm Brian Stutland here with Joe Teague. Joe, give us a breakdown of what it means to buy a call. I think that's kind of a timely issue in the market right now on how to control your risk owning a call.
Yeah, Options 101, buying a call. So when you buy a call, you're actually betting on the stock will go higher, but you're going to require it to be above your strike price. So you get to be long the stock above the strike you choose to buy on your call. The only thing you could potentially lose is the initial cost, the premium you pay for that call. So your downside is capped. The chart of it just looks very simple like this. Being long stock, of course, you would be better off if the stock goes higher, but you do have that downside risk being long stopped if you have the max loss of losing everything you put into it. With a call, you know what your loss potential could be. With that trade-off is that your upside is just a slightly bit lower. So in the environment like we're in, where we have the rising market and rising volatility, it makes sense to me if I'm going to be long stock I'd rather be express that position with a long call position because I have a limited downside and I'm going to participate in most of the upside.
Well, there you have it. That's our Options 101 trade of the week. Joe Teague, great show. A lot of information, some scary things out there in the market. I'm Brian Stutland, Equity Armor Investments. We try and do our show with Trader Hub and sponsored by the MyX. We're excited to bring you more. Tune in next week. This week was Tuesday. We're back to our normal time schedule, Monday, 1 p.m. Eastern. Tune in, subscribe, like, and we'll bring more information to you, help us grow our following here.